The footage wasn't supposed to be public. Grainy, handheld, shot quickly, like someone knew they didn't have much time, but once you see it, it's hard to forget. Rows of steel racks, vault doors open, and where there should have been stacked silver bars, there's space. Too much space. Now I need to be very clear right from the start. What you're about to hear is not confirmed by any official audit. No regulator has signed off on it, no central bank has acknowledged it. But the reason this matters is not because the footage is proven. It's because of what happens if it's even partially true. Because silver isn't just another commodity. It's not a tech stock. It's not crypto. Silver sits at the intersection of money, industry, and trust. And when trust breaks there, the consequences don't stay contained. Over the last few days, unverified videos and internal leaks have been circulating in private trading groups and institutional chat rooms. They all point to the same disturbing claim. Multiple major silver vaults, allegedly tied to large international banks, may not hold the metal they're supposed to be safeguarding. Not less than expected, not temporarily delayed, but functionally empty. And if that sounds extreme, it should. Because this isn't about one warehouse or one bad actor. The allegation is systemic, coordinated, multi-bank. Here's why the timing of this matters. Silver has just come off one of the most explosive runs in modern financial history. Prices surged, demand spiked, and paper claims on silver multiplied far faster than physical supply ever could. ETFs expanded, futures volume exploded, synthetic exposure ballooned. All of that only works under one assumption, that the physical metal is there if it is ever demanded. The footage challenges that assumption. And markets don't collapse when something is proven false. They collapse when people realize it might be. Right now, silver markets are built on confidence layered on confidence. Vault reports, bank assurances, clearing mechanisms, settlement promises. Remove even one layer, and the entire structure starts to wobble. This is how financial accidents begin. Not with headlines, with whispers. What makes this situation more dangerous is that silver is deeply embedded in industrial supply chains. Solar panels, medical equipment, electronics, defense applications. If physical silver availability is overstated, it's not just investors at risk. It's manufacturers, governments, entire sectors that assume uninterrupted access. And there's one more detail almost nobody's talking about yet. The banks allegedly linked to these vaults are the same institutions that dominate silver derivatives trading. They are market makers, liquidity providers, counterparties on both sides of the trade. If the metal isn't there, the question isn't who's lying. The question is who's exposed. Because if too many people ask for delivery at the same time, paper contracts stop being paper profits. They become liabilities. In the next part, we need to understand how silver vaulting actually works, why paper claims can exceed physical supply by design, and where the cracks usually form first when that system is stressed. And once you see that structure clearly, the footage starts to look a lot less random. To understand why this footage is so destabilizing, you have to understand how the silver market actually functions behind the scenes. Not the simplified version most investors are shown, but the real mechanical structure that keeps prices moving day to day. Most silver exposure in the world is not backed by bars sitting in a box with your name on them. It's backed by promises, layers of promises. When a bank reports silver holdings, that metal is often part of a pooled system. Multiple claims can exist on the same inventory. One bar can technically satisfy several obligations, as long as everyone involved agrees not to ask for it at the same time. This is legal. It's disclosed. And under normal conditions, it works. Until it doesn't, because the entire structure depends on behavior. It assumes most participants will settle in cash. It assumes delivery requests will remain statistically small. It assumes confidence will hold. That's why vault transparency is so critical. Not because every ounce needs to move, but because everyone needs to believe it could. Here's where things get uncomfortable. The footage circulating allegedly shows vaults associated with custodial chains used by multiple banks. Not retail vaults, not private storage, institutional grade facilities that are supposed to anchor the paper market. And what stands out isn't just the lack of silver, it's the configuration. Empty rack space where standardized bar stacks should be. Tagging systems visible, but no corresponding inventory. Areas that appear prepared for storage, but unused. That raises a specific concern, rehypothecation. Rehypothecation is when the same asset is pledged multiple times to support different obligations. In derivatives, heavy markets, it's common, efficient even. But it introduces fragility, because if the base asset is overstated, every claim above it becomes questionable. In silver, rehypothecation risk is amplified by leverage. Futures contracts, unallocated accounts, ETFs, and structured products all reference the same underlying pool. The paper-to-physical ratio is already extreme under normal estimates. If those estimates are wrong, even by a modest margin, the imbalance becomes dangerous, and this is where multi-bank exposure enters the picture. Large banks don't operate in isolation. They clear through shared systems. They net positions against each other. One bank's short exposure is another bank's hedge. The interconnection is efficient during calm periods, but it's brutal during stress. If one major vault fails to deliver, counterparties immediately reassess every linked exposure. Liquidity dries up, margins spike. And what begins as a silver issue quickly becomes a balance sheet issue. This is why rumors alone can move markets. You don't need proof of emptiness. You only need enough doubt that participants start asking different questions. Instead of, what's the price, they ask, what's the settlement risk? And once that shift happens, behavior changes fast. In the next part, we need to look at why silver, specifically, is uniquely vulnerable to this kind of shock right now, and why the last price rally may have set the stage for exactly this kind of stress, because this didn't come out of nowhere. It was built quietly over time. The reason silver is so exposed right now has almost nothing to do with conspiracy and everything to do with timing. Silver didn't just rise. It surged fast enough to change behavior. When prices accelerate that quickly, they don't just attract buyers. They alter incentives across the entire system. Producers hedge differently. Banks restructure exposure. Vault operators optimize inventory usage. And most importantly, holders of physical metal begin to reassess whether keeping it stored makes sense. This is where stress begins to form quietly. During a rapid price run, paper demand expands much faster than physical supply. Futures volume increases because it's easy. ETFs grow because they're convenient. Structured products multiply because clients want exposure without logistics. None of that immediately requires metal to move. But underneath all of it, there's an assumption that physical silver is available somewhere in sufficient quantity. Now introduce a second factor, delivery complacency. For years, the vast majority of silver contracts have been settled in cash. Delivery requests stayed manageable. That created a behavioral equilibrium. Banks became comfortable running thinner physical buffers because, statistically, it worked. But price spikes disrupt that equilibrium. As silver rose, something subtle changed. A small but meaningful number of participants began asking different questions. Not, how high can it go, but can I actually get it? That shift doesn't show up in headlines. It shows up in internal messages, in delayed delivery timelines, in sudden changes to contract terms, in quiet incentives to roll forward instead of standing for metal. Those are early warning signs, and here's the part most people miss. Vaults don't empty overnight. They thin. Metal moves out incrementally. Bars are leased. Inventory is swapped. Custodial arrangements are optimized. On paper, everything still balances. Until one day, it doesn't. If the footage is even directionally accurate, it suggests that the thinning process may have gone too far. Because an empty-looking vault doesn't necessarily mean fraud. It can mean metal was moved to satisfy other obligations. The problem is, when those obligations stack faster than replacement supply arrives, silver replacement isn't instant, mining output can't surge on command, recycling responds to price, but with delay. Industrial demand doesn't pause just because markets are nervous. So if vault inventories drop below a functional threshold, the system becomes hypersensitive. At that point, even a rumor can trigger defensive behavior. Participants rush to secure positions. Delivery requests increase. Banks attempt to source metal simultaneously. That's when bottlenecks appear. And this is where the alleged multi-bank angle becomes critical. If several institutions relied on overlapping inventory assumptions, one shortfall cascades into others. Suddenly, the question isn't whether silver exists globally. It's whether it exists where and when it's contractually required. Markets don't wait for audits to answer that question. They react to probability. In the next part, we need to examine why banks might have allowed this exposure to build, how incentives inside the system reward this behavior, and why the first visible cracks often appear in the least expected places. Because the real risk isn't the footage itself. It's what it implies about decisions already made. From the outside, it is tempting to ask a simple question: why would banks ever allow themselves to be this exposed? The answer isn't a recklessness, it's incentives. Inside large financial institutions, silver isn't treated as a fragile asset that demands caution. It's treated as a flow product, a balance sheet tool, something to be optimized for efficiency rather than safeguarded for worst-case scenarios. Holding large amounts of idle physical metal is expensive. It ties up capital. It creates storage costs. It generates regulatory scrutiny. So systems evolve to minimize unused inventory while still supporting market activity. As long as contracts settle smoothly, this looks smart. The problem is that the same structure that maximizes efficiency also maximizes vulnerability when conditions change. Traders are rewarded for returns, not for redundancy. Risk models are calibrated to historical behavior, not rare behavioral shifts. And delivery stress events are, by definition, rare. Until they aren't. Another factor is fragmentation. Silver vaulting isn't centralized in one place. It's distributed across jurisdictions, custodians, sub-custodians, and clearing agents. Each layer sees only part of the picture. No single desk has perfect visibility into aggregate physical exposure. That means systemic risk can build without triggering alarms. A vault operator sees inventory moving but assumes it's temporary. A trading desk sees rising paper demand but assumes delivery behavior won't change. A risk team sees balanced books but assumes counterparties remain liquid. Everyone is technically correct. Collectively, they may be wrong. This is how structural blind spots form. And when something finally forces the system to reconcile paper with physical, the adjustment isn't smooth, it's abrupt. What's particularly concerning about the alleged footage is not just what's missing, but what appears prepared. Empty racks, still labeled, system still active, infrastructure intact. That suggests expectation, as if the metal is supposed to be there. If true, that points to timing mismatches rather than a single moment of failure. Metal moved out faster than it came back in. Obligations accumulated faster than supply replenished. That kind of imbalance doesn't correct itself quietly. It corrects when someone insists on delivery and won't accept alternatives. And that's when banks face a choice. Source metal at any price, renegotiate terms, or delay settlement. All three options send signals to the market. Signals traders are trained to read. In the next part, we need to explore what happens once those signals start circulating, how confidence erodes faster than inventory, and why even a small number of delivery disputes can escalate into something far larger than the silver market itself. Because history shows us this pattern doesn't stay contained. Once confidence starts to slip, the mechanics of escalation are brutally fast. Markets don't wait for confirmation, they front-run risk. The first stage isn't panic, it's precaution. A few large players quietly change behavior. They stop rolling contracts forward. They request delivery instead of cash settlement. They ask more questions than usual. Individually, none of this looks alarming. Collectively, it changes everything. Delivery requests don't need to surge dramatically to cause stress. They only need to exceed assumptions. If a system is built on the expectation that, say, 2% of contracts stand for delivery, then 4% is a crisis. Not because silver doesn't exist globally, but because it can't be mobilized fast enough in the right form at the right location. This is where liquidity fractures. Banks that normally act as intermediaries suddenly become principals. They're no longer matching buyers and sellers. They're sourcing metal themselves. And when multiple banks do that at the same time, they compete against each other. Prices gap, lease rates spike, availability disappears. At this stage, communication changes. Traders stop discussing price targets and start discussing timelines. Settlement dates become flexible. Incentives are offered to delay delivery. Small concessions are made quietly to avoid larger disclosures. These are not hypothetical behaviors. They're standard responses to physical stress in any commodity market. The problem with silver is scale. Silver underpins an enormous volume of paper exposure relative to its physical footprint. When confidence erodes, that leverage works in reverse. Every ounce suddenly matters more. And here's where the alleged multi-bank dimension becomes dangerous. If several institutions are simultaneously exposed to the same physical shortfall, coordination becomes difficult. No one wants to be first to admit a problem. No one wants to trigger regulatory attention. So delays compound. Meanwhile, information leaks. A delayed delivery here, a changed contract clause there, a rumor about sourcing difficulties. None of these confirm anything on their own. But together they create narrative momentum. Narratives move markets faster than facts. Once that momentum builds, even well-capitalized institutions can find themselves reacting instead of controlling outcomes. Hedging becomes expensive. Counterparties demand more collateral. Clearing requirements tighten. And suddenly, what began as a question about silver availability becomes a question about balance sheet resilience. In the next part, we need to zoom out and examine why this kind of stress doesn't remain isolated, how it can spill into broader financial plumbing, and why regulators often arrive after the most damaging moves have already occurred. Because the real danger isn't a silver shortage, it's a loss of confidence in settlement itself. Settlement is the invisible backbone of modern finance. Most people never think about it because most of the time it works. Trade's clear, obligations net out, promises cancel each other cleanly. But when settlement is questioned, everything slows down. Silver is plugged directly into that plumbing. Futures exchanges, clearinghouses, prime brokers, custodians. When stress appears in one node, it transmits through the system not as a price signal, but as a trust signal. This is where contagion begins. If counterparties start doubting whether silver obligations can be honored smoothly, they reassess unrelated exposures with the same institutions. Credit lines tighten, collateral requirements increase, liquidity that was assumed to be there suddenly isn't. And this doesn't require a confirmed default, it only requires uncertainty. Historically, regulators respond to these situations after volatility erupts, not before. They investigate once markets are already moving. By the time statements are issued, positions have shifted and damage is done. That's why unverified information is so dangerous. It creates a window where behavior changes before official narratives catch up. In the current situation, the footage itself may never be authenticated publicly. It doesn't have to be. What matters is that enough sophisticated players have seen it, discussed it, and adjusted accordingly. Because institutional investors don't wait for press releases. They read between lines, they monitor delivery times, they track lease rates, they notice when metal becomes harder to source quietly. And when those indicators align, they act defensively. If that's happening now, the visible effects won't start with headlines about fraud. They'll start with subtle dislocations, unusual spreads, persistent backwardation, sudden spikes in collateral demands. To most observers, those look technical. To professionals, they look like warning lights. This is how localized stress becomes systemic, not through a dramatic announcement, but through a chain reaction of protective behavior. In the next part, we need to address the most uncomfortable question of all. What happens if authorities step in, how narratives are managed in situations like this, and why official reassurance can sometimes accelerate fear instead of calming it. Because once trust is questioned, words alone don't always restore it. When authorities step into situations like this, their primary objective isn't transparency, it's stability. That distinction matters. If stress is building in the silver market, regulators and central bodies face a narrow set of choices. They can investigate quietly, they can encourage private resolution, or they can issue public statements designed to calm markets. Each option carries risk. History shows that early reassurance often has the opposite effect. When officials say, "There is no problem," sophisticated participants immediately ask why that statement was necessary. Confidence, once questioned, becomes extremely sensitive to tone and timing. And silver presents a unique challenge because it sits outside direct monetary control. It isn't issued by a central authority. It can't be created digitally to meet obligations. If physical availability is strained, there's no mechanism to print relief. That limits intervention tools. In similar past episodes, authorities have leaned on narrative management, emphasizing that contracts allow for cash settlement, highlighting that delivery delays are procedural, stressing that global silver supply is sufficient in aggregate. All of that may be technically true. But markets don't operate on technicalities. They operate on expectations. If participants believe settlement risk is rising, they act accordingly regardless of official framing. Another complicating factor is jurisdiction. Silver vaulting and trading spans multiple countries, each with its own regulators. Coordinated responses are slow. Information sharing is imperfect. During that delay, markets move. And then there's the political dimension. Large banks are deeply embedded in national financial systems. A public admission of multi-bank exposure tied to physical shortfalls would raise uncomfortable questions. Not just about silver, but about oversight, risk controls, and derivative leverage. So resolution tends to be opaque. Problems are patched, not explained. Incentives are offered behind closed doors. Temporary measures are introduced quietly. By the time clarity emerges, price damage is often already done. For investors and observers, this creates a dangerous asymmetry. Official silence doesn't mean nothing is happening, and official reassurance doesn't mean risk has disappeared. Which brings us to the final question that actually matters. If this footage is wrong, markets may stabilize and move on. But if it's even partially right, behavior has already changed in ways that can't be undone easily. In the final part, we need to bring this together. What to watch, what signals matter more than headlines, and why the silver market may be closer to a structural inflection point than most people realize. Because the biggest financial breaks don't begin with crashes. They begin with doubt. At this point, the question isn't whether the footage will be proven real or fake. That's almost beside the point. The real issue is what happens next. Because markets don't wait for certainty. They move on probability, behavior, and incentives. And those have already shifted. If this situation resolves quietly, you'll see it first in the data, not the news. Delivery times normalize, lease rates ease, spreads compress. The system absorbs the shock and confidence slowly rebuilds. But if the stress is real, the signals will persist. Watch for sustained backwardation in silver contracts, not brief spikes, but patterns that refuse to normalize. Watch for unusual cash premiums offered to avoid delivery. Watch for changes in ETF language, settlement terms, or reporting cadence. These are not cosmetic. They are pressure valves. Most importantly, watch behavior, not statements. Institutions rarely say what they're worried about. They show it through what they stop doing. Reduced exposure. Shorter contract durations. Quiet withdrawals from activities that once seemed routine. That's how risk exits before headlines arrive. If multiple banks are exposed to overstated physical availability, the adjustment will not be orderly. It will be staggered, uneven. Some participants will exit early. Others will be forced to react later at worse prices. This is how losses concentrate. Silver doesn't need to disappear for damage to occur. It only needs to become temporarily unavailable where contracts demand it. In a leveraged system, that's enough. And if confidence in one settlement layer cracks, attention quickly turns to others. Gold, base metals, even non-commodity markets that rely on the same counterparties. That's why this matters beyond silver. This isn't about believing a video. It's about understanding how fragile systems behave when trust is questioned. The most dangerous moments are not when fraud is confirmed, but when participants can't agree on what's true. We're in that window now. Nothing may happen, or something already has. The difference will be visible not in headlines, but in how the market moves when it's supposed to be calm. That's where the truth usually shows itself.